But what's the index call this morning, given that we seem to be hitting a little bit of a tough zone for the market? So it's a no trade from Naresh. Kunal, though, calls it a hold, as well as Kush as well is recommending a hold for the Nifty. So it's a consensus call pretty much over there. For the Nifty Bank, it's a hold from Kunal, from Naresh, as well as Kush too.
Okay, let's take stock of some of these other movers as well in pre-open. Motherson Sumi, on account of that acquisition that they have done, is showing an uptick of around 7%. The brokerages are quite positive. Nomura upgrade coming in 7% higher. LTI Mindtree getting a boost as it is going to be a part of the Nifty 50, so 3 to 4% higher. LIC Housing Finance as well, which will become part of your Nifty Financial Services Index, is also trading high by 2%. Then you also have Paytm reacting positively to the monthly update. Can't say the same about Bandhan Bank because that's reeling under pressure. At least in the pre-open rates, it's showing a downtick of 5%. The CFO resignation and one of the slowest growth coming in for the entire industry from Bandhan Bank is something that is putting pressure. You also have Emphasis, which is down, Suzlon, Delivery, Sign. These are some of the other names which are looking on the back foot as well. But what would be the trade at this point of time? Kunal, what is that you are spotting at this point of time? And overall for Motherson as well as some of the other big buzzers like Paytm, what would be your recommendation?
Well, I would be bullish on both of these names, Samvardhana Motherson as well as Paytm. In fact, Paytm, I think on the short-term charts have actually gone into a mild correction from, I think, 885, 900 plus levels. The stock has come back towards 850 odd mark. So I believe the short-term risk-reward looks a bit more better for Paytm. The stock has settled into a trading range. So I think that's the good part, because when you settle into a trading range, the indicators, they come back into a neutral territory or the moderate zone. So that also complements the risk reward in terms of trading. Even for Samvardhana Motherson, the stock I think has shown an excellent recovery in the last 4 to 5 months. I was actually looking at the charts. In fact, closer to 65, 67 is where we had given a positional call on Samvardhana Motherson. But what the stock is now showing at 80, 85, 84 plus levels is a big breakout of a double bottom pattern on the monthly time frame charts. So what started off as a strong trending stock on a weekly basis is now engulfed itself into a big breakout chart on the monthly basis, and I think that's going to be more of a turnaround for Samvardhana Motherson. So I would continue to have a bullish stance, and possibly in the next 3 to 6 months, I would even expect the stock to scale past about the 3-digit levels of 100 plus.
Right, okay, getting set then for the market open this morning. And yeah, while the bull run definitely is intact, we managed to gain for a 6th consecutive session. The FII buying continues. Bajaj Twins were the ones which led the gains yesterday, while Reliance dragged. PSU banks and IT year-to-date have been one of the key gainers sectorally. Metals and energy, of course, are yet to play catch-up. Having said that, like our chartist as well mentioned, that maybe in the near term, we could have hit a bit of a hurdle, or at least some sideways consolidation very much could be on the cards. So that is what seems to be the case, because some of the indicators are getting into that overbought territory. But we're not complaining. Just to catch up our breath around that 19,400 mark only means that there is going to be a bigger move when next the market moves. And also you've got to see the pace of the move in the Nifty ever since hitting that 19,000 mark. We've been clocking almost 100 point on a daily basis. So that's okay if we catch a little bit of breath at this juncture. Having said that, we've of course been marking the valuation picture as well. Nifty has already seen a 9.5% gain in the first quarter alone. This has been the highest gain that we've already seen in the last 7 quarters. For the mid-cap index as well, the highest gain of almost 18.5% in the last 10 quarters. And Nifty small cap index, which has seen a gain of about 20%, which is the max in about 8 quarters. So maybe a little bit of catch-up of breath. Flat for the Nifty, pretty much in line with what the GIFT Nifty as well was indicating this morning. And the handover as well, to be fair, from the global cues has really been all over the place. A lot of important stocks, and I want to first see what HDFC Bank is up to, because the quarterly update for the combined entity has come out 2% lower for HDFC Bank right now in trade. And, the standalone business on a sequential basis, the loan growth, as we understand, has come in at a 26-quarter low. The merged business loans are also up just about 0.6% on a sequential basis. Yes, it's a very large base that we're talking about, but at the same time, this has fallen short of what the street was anticipating. So HDFC Bank is your big drag this morning, down about 2.25% as we speak. Having said that, impressive numbers coming in from Indices Bank. The advances have seen an uptick of about 21%. AU Small Finance Bank, though, on a sequential basis, the deposits are down, but the loan growth has seen an 8% jump on a sequential basis. Then, of course, there's RBL Bank. The advances have risen more than 4%. And deposits are up 1% sequentially. That stock as well holds out in the green as we speak right now. AU Small Finance Bank, that as well will just come up for you on your screens. And then, of course, let's see what LTI Mindtree is up to, considering this is the one which is going to be replacing HDFC in the Nifty 50 come July 13th. That has gapped up nearly about 2% as we speak right now. A lot of other quarterly updates as well have come in. Bandhan Bank, not just the CFO resignation, but the fact that the Q1 advances have fallen 5.5% on a sequential basis. Bandhan Bank is lower by about 4.25%. I also want to revisit what Bajaj Finance is up to, and after that mammoth 7% move yesterday, what's the stock up to today? It's taking a bit of a breather, much like the Nifty started off absolutely flat. Eicher Motors, Hero MotoCorp, what's the follow-through reaction on those stocks? Eicher Motors falls a little more, 1.25% lower, and Hero MotoCorp is seeing just some mild gains coming in. But yeah, for the benchmarks, it's a very, very quiet start as we see, and I can spot some technology movers there. Those seem to be the only spots of green. ICICI Bank as well, a mild green there. HCL Technologies, Bajaj Auto, you've got a Tech Mahindra, HDFC Life, Divis. They all have started off in the green. And of course, there's been a lot of those pharma newsmakers too, along with, of course, Motherson Sumi or Samvardhana Motherson, which should also come up for you on your screens. That's a newsmaker in trade and should be holding up in the positive as pharma, I guess, is, and all the brokerage notes which seem to be pretty bullish on this Yakchio acquisition, which they think is going to be quite significant for them. 5.25% gap up coming in for Motherson.
Oh, well, yes, let me just flag out a few more names. LIC Housing is higher by 4%. We were just chatting about that counter. Paytm trading with a gain of around 2%. You also have LTI Mindtree, which is pulling all the actually IT stocks higher, and that's the reason Nifty IT is one of your best performing sectors. Genus Power, the management that we are just speaking with, that entire $2 billion platform is something which is sending that stock higher by 9%, and a rub-off impact on HPL Electric as well, given it works in the same segment of smart metering. So these are some of the counters that we are watching out for. And look at that advance decline ratio, very impressive. 1,300 stocks advancing to around 400 stocks declining. But quickly coming to you, Naresh, what's the trade that you're spotting?
So that's a buy on Hindustan Unilever. The stock is setting up for a breakout above the 2700, 2750 mark. This could be a defensive trade which could do an aggressive move towards 3000 in the short term.
Okay, there you have it. That's Naresh's first trade, HUL, looking poised for a breakout. What about you, Kunal? What's the trade that you're punching in?
I'll be looking to buy Reliance Industries. I think closer to 2,680 on the futures could be a very good trade. The risk reward would be a lot more better as well as attractive for the stock.
Okay, let me just flag out Macrotech Developers as well, because that stock is down 3%. No surprise, because of course on a sequential basis the growth had slowed a bit. To add to that, there was this entire debt which had spiked. So that's the reason we are seeing pressure on that one. Dixon Tech is also down 2%. Naresh, if I still have you with us, wanted your take regarding the HDFC twins. Would you recommend a buy, or till July 13th be on the sidelines?
So it would be a case wherein one looks to accumulate at lower levels. 1650 to 1700 is a good zone to buy into HDFC Bank. We'll keep seeing this gap up, gap downs with the new changes happening. But overall, the structure is very clear. The stock attempted an all-time high. Eventually would go much higher post 13 July. Overall, over the next 1 to 3 months, positive on the stock.
That's a take coming in. A bit of a surprising move, Kunal, on Strides Pharma. We were all hoping that that entire 700 crores coming on the balance sheet will augur well, but that's seeing a downtick. You're still positive, right? You're maintaining that view.
Yeah, I think it's been an excellent chart. So what I meant, Anisha, was that the long-term structures change when you see such kind of a strong non-stop like a price trend in a matter of 3-4 months. Because when these kind of trends happen, the stock generally indicates that the buying or the flow of liquidity changes significantly. So the money moves into the volumes move into the buying side more as compared to the volumes move into the selling side when the stock is actually moving lower. And those are the kind of trends which establish themselves over a period of time. So I would believe that that's the case for a stock like Strides Pharma. The stock has seen an exponential jump in terms of volumes in the last 4 to 5 months cumulative as compared to the last 1 year of the volumes for itself. And I think even if such kind of corrections happen, that should be taken as a good buying opportunity.
Okay, that's the view coming in on some of those pharma counters. Keep an eye out on the Q1 operational updates as well from Poonawalla FinCorp. It's been a 41% growth in their AUM. Meantime, let's also hear it out from Ravi Dharmshi, CIO, ValueQuest Investment Advisors. He speaks about the financial sector and says that there's a lot of potential within manufacturing.
Within financials, of course, we've been bullish on the lending companies, but non-lending financials are also at a very interesting juncture. See, India has brought into its fold almost 40% of the unbanked population in the last 5-7 years. There is a move away from hard assets, physical assets like real estate. Real estate and gold form a disproportionate portion of the majority of Indian households. Now there is a move away from it towards financialization. So there a lot more money is going to flow into financial products. So non-lending financial companies are at a very interesting juncture. And whether I say it's the insurance companies or the wealth managers or the capital market related plays, these are all still suffering from the correction of the last 2 years or the last 3-4 years, where there were some regulatory kind of pressure on the company, or there was exceptional pressure on the yields, which was leading to the companies not performing. Now, some of the pressure is relieving, like we saw in the case of AMCs, that, okay, the regulator took a pragmatic view and decided to hold back and take the industry's feedback. So just like that, on the insurance front also, there was an overhang on the a particular company from promoters selling. They took back. So all those overhangs are now going away, which is leading to this space also suddenly becoming very, very attractive. So I would say within the financials, non-lending financials are probably at a slightly better risk reward at this juncture.
So would you be looking at doing the following: reduce the exposure to corporate banks and maybe shift towards AMC or insurance or NBFCs, or you've already done that?
No, we are not looking to reduce the exposure on the lending side, but we are definitely looking to increase the exposure on the non-lending side. So it is not a either or call for us. In fact, we are bullish on both the spaces.
You were bullish on manufacturing, you were bullish on alternate energy, you were bullish on financials. We've discussed financials. What about the other two themes? Especially energy transition. We spoke with you when we had visited the factory of Wari. What is the update there? What is happening in that space? Because now it seems to be the pet theme for everybody.
Yeah, I mean, I think this is a theme that is going to sustain for another 10 years, maybe more also, but let's speak about next 5-10 years. And if that is the case, solar is going to be the backbone. In fact, other places like wind are also doing well within that theme.
Okay, it's a decent opening for the market. 19,400 has been held, at least at the Nifty level. But the big question that we're asking, are there more legs to the rally, or we are reaching a bit of a toppish zone? Let's discuss all of that with Mr. Mahesh Patil, the CIO at Aditya Birla Sun Life AMC, joining us on the show. Mahesh, hi, good morning. Thank you so much for making time. That's exactly the first question. Your take on the market?
Yeah, good morning. So I think markets clearly, taken a new high. But if you look back, right, it's around 18 months back when the market reached the earlier peak, right? So since then, okay, we have seen that a lot of things have changed. The earnings growth has been fairly strong. The valuations, okay, which were expensive at that point in time, right, around 18 months back when the earlier peak happened, okay, because of around 25% earnings growth, valuations are now slightly higher than the long-term average, but not too expensive. We've seen that on the domestic side, I think there were concerns about growth slowing down. Even global growth concerns, actually growth has slightly surprised on the higher side. So I think while it looks like the market is at a new high, but we think that if you take a slightly one-year view from here, I think the earnings growth this year, for example, in FY24, should be around 16%. That's what we are looking at, even consensus around that level. So given that, I think the market can continue to scale highs. Obviously, there will be some correction pullbacks in the market depending on how the global cues are. Because I think one difference which I see in the strength of the market is that the breadth of Indian market has been much, much better compared to the rally what we are seeing in the, say, the US market, S&P, which has been driven by a few handful of the stocks, right? If you remove those technology-led rally, it's not been that great. Whereas in Indian markets, if you look at the number of stocks which have amongst the BSE 200, which have moved above the 200-day moving average, it's almost 70% of the stocks. So it's much more widespread. And it's spread across sectors, right? It's not just a few sectors. So that gives a lot more comfort that the rally should sustain.
Hi, morning, Mahesh, and wanted to also get in your thoughts on the entire IT sector, because that's really borne the brunt of a pretty, choppy or worsened macroeconomic environment. You've also had the consistent rate hikes. What is the outlook on how you've seen a lot of these companies take on all of this news? And do you believe that one would need to be very selective when it comes to IT?
The IT sector has underperformed last 1 year, one of the worst performing sectors, rightly so because of global growth concerns. And we've seen some downgrades to earnings growth or top line growth in the last quarter. I think at the end, by the end of this quarter, you might see another 3-4% downgrades to earnings. But I think that should be the bottom in terms of the downgrade, because we have seen that while there has been some slowdown in the discretionary spend, there are some large ticket wins, okay, which are there, where companies are trying to really do cost takeout deals. And I think the overall spend on digital, okay, which has started during the COVID, I think will continue for the next 3-4 years. So we think that, this year, where you will see the growth slowing down, but I think post that, I think it should again crawl back a bit, not to the levels which was there a couple of years back, but definitely around, say, 10% or so. And I think with the correction in the IT stock, and the valuations are now more reasonable. Companies are doing buybacks. The dividend yield is very good. So we see limited downside here in the IT sector. And within that, I think this time around, I think in this period, there will be a lot more divergence in terms of how the company reports their earnings. I mean, there'll be few companies which will report around 13-14% top line growth. Others will report low single-digit growth. So I think it might be that companies which are doing good execution, I think they would continue to do well. So it could be a bit stock specific at this point in time, but overall in sector, we think it's a good time to start looking at it now. In the next couple of 2-3 months, could be a good time to really build exposure in the IT sector.
Okay, so that's about the IT sector, but I wanted to come back to the first point that we were discussing with respect to the markets. Now, given the fact that we are at least reaching towards those peak of the valuation range, what's the strategy that you would recommend at this point of time? Because I do remember you have a multi-asset, portfolio as well. So what's the recommended mix right now with respect to equities, debt, other assets?
So you're right. I think markets are fairly priced over here. So it's not like it is very attractive. But at the same time, the risk reward is still fairly reasonable for a long-term investor to come in at these levels. We think that the risk reward across asset classes between, say, equity, debt, is fairly well balanced at this point in time. So we have two funds. One is the Balanced Advantage Fund, where it's a dynamic asset allocation over there. And we have the multi-asset fund, which is across equity, debt, and precious metal, which is mainly gold. So there, our allocation to equity is near our median range, which we have. So in our multi-asset fund, that is around 65% into debt, around 13-14% into gold, and the balance into debt. And even in our Balanced Advantage Fund, okay, our asset allocation model is suggesting that the equity allocation should be closer to around, say, 50 to 55% in that range. So we are in the median range in terms of asset allocation, which shows that the risk reward in equity is fairly balanced. And I think that's what I think one should recommend investors also really to follow, that continue with the SIPs. Don't go aggressive at the market at this point in time, but again, continue with your STP SIPs, and any market correction or pullbacks can be a good level to increase the equity allocation, because the longer term trend looks to be on the up.
Mahesh, a lot of market experts as well that we've been speaking to are now, becoming a lot more open to the fact that there is potential in some of these new age tech companies, with them going in for a cleanup act, putting the focus on profitability and pulling up their socks, if you will. Do you as well see merit in individual names within this space, or perhaps some interesting IPOs that you'd like to highlight?
Yeah, so I think the new age technology companies have actually, a lot of these companies are now focusing on profitability. Earlier, it was the top line growth, and I think now with them getting listed, I think the listed market space is also looking at profitability, because that's how they would want to value these companies based on that. So I think given that, I think many of the companies where they're already kind of breaking even at the EBITDA level, or likely to do so in the near future, one can actually now value them based on a traditional matrix, not necessarily on a 2-year earnings, but over the next, say, 3 to 5 years earnings time frame. And I think some of these companies are growing much faster, okay, than the broader industry, so they will continue to be high growth companies. But yeah, so I think selectively, I think in the space, companies which are now established their leadership, right, where the competitive intensity is not much, because that's a worry in this space, because if the competitive intensity is heightened, then companies continue to burn money, and the road to profitability is unclear. So I think wherever these criteria are met, and where earnings, you can project the earnings over the next, say, 5 years and then discount that, and you see value, I think those are the companies which we are looking at in the new age technology space.
All right. Thanks so much then, Mahesh, for joining in, giving us a view on the overall market outlook. So that's the take really coming in. There is room for more upside on the Lal Street, and we are looking at a fairly balanced risk-reward ratio down the line. A quick check-in as to what the market is up to in trade, and currently circling around this 19,400 mark. It's pretty quiet when it comes to the frontliners. If anything, it's the broader markets that are showing you a bit of fervor. Of course, those individual stocks that are in focus on the back of news. But other than that, something like an MMTC is a buzz, Karur Vysya Bank, an IDBI Bank that's gained about 3% in trade, Minda Corp as well as RBL Bank. Those are some of the other stocks that are in focus. But let's put the spotlight then on Jana Small Finance Bank. Talk about the kind of financial recovery as well that we've seen over the last 5 years. And we've got Ajay Kanwal, the Managing Director and CEO of the bank, right here with us. Thank you so much for taking time out and joining in. Let's just talk a little bit about, how business has been shaping up for the bank as of now, in light of the fact that there has been a pretty stellar growth in terms of your overall profit, which has grown in about double digits. What is your projection in terms of your overall financial position?
So thanks. So I think first, very importantly, is that where the bank is today, the bank's balance sheet over the last 5 years, like you mentioned, has become very profitable. We have made sure that the bank balance sheet now incrementally reflects that of a customer. And when I say customer, it's largely an individual consumer, whether in salaried or in business, or an MSME customer. And the big change that has happened really is it's moved towards more housing, more secured loans, and has become less of unsecured loans. So that's number one. In terms of future growth, honestly, all the businesses we are in, so we are in the underserved market. Underserved markets, the growth rates are anything in the 20+ range. So I do think that we will meet the growth rates that you can expect from the industry. Sorry.
Sorry,
please.
no, please
No,
go
please
ahead.
go ahead.
No, finish your point.
I'm done.
Okay. No, I was just talking about, how it's been a conscious strategy for you to try and change your loan mix. Tell me, is that going to be an effort going forward as well, wherein there will be lesser of unsecured loans and more, like you said, to try and replicate the customer of today?
So absolutely, the idea when we began a bank really was we need to make sure the consumer, in our case, an underserved consumer, who is not very comfortable going with banks and probably dealing with multiple entities for loans, right?
Yeah.
Where he goes for housing loan will be different from where he approaches for a car loan to a gold loan, etc. Why don't we create under one roof
The one-stop shop.
the one-stop shop? Importantly, give him digital answers, which he could choose. So it's not a forced digital answer, but a digital answer the customer chooses. And third, let's make sure that he feels comfortable walking in, because most people are like, how do I go to a bank? Whom do I talk to? And unless you don't know somebody in a bank, you're really not comfortable approaching the bank. I just want to rewind back on the digital piece.
Sure.
So while we have digitization, which I think is best in class, we have made sure that if you do call up the call center, you are 90% going to talk to a person. Because we do know that IVRs don't please anyone, right? So we try to make sure that we are doing what is most intuitive for a consumer. What would a consumer really like? Like when we keep holding on to press 1, press 2, we don't like it, right? So why would any of my customers like it? So everything is around digitization, service. Bank's balance sheet should reflect that of a consumer, and make sure the customer is very comfortable coming to the bank.
But today, in today's day and age, as consolidating as the banking industry may have become, but there are still a plethora of banks out there, especially in the segment that you're competing with. What would you say is Jana Bank's niche? How is it that you stand out?
So I must say that if you look at the challenge both in India and globally, the penetration of credit in the middle to bottom end of the economy is always very low. And that problem everybody enjoys. And that comes from 2 or 3 factors. One is the ticket sizes are small. So obviously, the income you make per ticket is a challenge. Second, understanding incomes is a challenge. And 3, the formalization of credit, which means customers are not really paying you always through bank accounts. Sometimes you have to go and collect. The customer education has to be higher. So I think from a competitive angle, yes, lot of players, but I think huge room to grow for all players. It's actually a lot of hard work. So you have to be last mile. You have to focus on customer education. You have to make sure that you are getting operating leverage, not because the ticket sizes are large, but you're doing multiple products with the customer. And you have to be as digital as you can. So you then create an economic model which actually serves the real middle end of the pyramid, which is the fattest piece, right? As you go down, it is the middle to the bottom end. It's a workable model. We have seen it, but it's hard work. That's how it is. So I think differentiation-wise, we are doing our best for the consumers. It seems to work. But we'll keep focusing on seeing what else they need.
Yeah, and just taking a look at the kind of fundraise recently, a lot of HNIs, Ramesh Damani, for instance, and Ashish Kacholia, etc. What does this 560 crore rupee fundraise mean when it comes to your overall capital adequacy?
So capital adequacy goes to 19%, which should by the end of this month, which is already passed, by the way. It's all growth capital. And I must say that we were really enthused because the quality of investors, the kind of fundraise, and their appreciation of what we had built and what we look forward to.
Right. The other thing I also wanted to talk about, what would you say, and I'm not talking about a quarter or 2 down the line, but let's talk 2 to 3 years or even 5 years. What's the growth runway looking like for you? Where do you think the maximum growth for Jana Bank is going to come in from?
See, in growth, I'll start with 3 things which are priorities. First, it has to be good growth, which means credit quality has to be really high standard. Second, it has to be growth which is around the consumer. So we don't have a target saying, let's make X product Y percentage. We're more focusing, what do a consumer need? Let's work with them. Then the third is, growth rate is not a challenge because every business line we are in grows upwards of 20%. Right? So if you take affordable housing growth rate for last year, for the industry, it was 25%. Right? So I think for us, growing is not the challenge. Then the other normal restraint for a business is, where are you present? So we are present in 24 states. We have 760 odd branches. We have 18,000 people. We have 45 lakh consumers. So I don't have a physical constraint, so to say. Digital, I'm fine. So To me, honestly, Aisha, it's less about how much can I grow. I just want to make sure I do good growth. I do at a
Quality.
steady pace, yes, and I do it in a way that I'm actually making consumer feel happy that that's my primary bank. When they think of Jana Bank, that's their home bank. And if we reach that point, I think then we kind of tick all the boxes.
You know, the one thing that I noticed, and right now you're getting the Q1 banking updates coming in, that the piece, the one important piece, of course, is, cost of funding. And, that's sort of falling for you as well. What's leading to this? And is there a scope for further decline here? Could that be a concern?
So yeah, I mean, for us, the past has been, conversion from a microfinance institution to a full-scale scheduled commercial bank. So obviously, we did get the advantage of raising public deposits and CASA. And as you know, CASA tends to obviously take the cost of funds down. And of course, cost of deposit also for us was much lower than the lending cost we were paying in the past. I think where we sit today, opportunity for us is really to grow a CASA business. So that's our top priority if you ask us. Cost of funds have been, I would say, it's if I remember right, the last year is up like 10 or 20 basis points. So I think cost of deposits have been more toppish in the last 1 year. We do think it will ease off as inflation is easing off. And for us, the opportunity of cost of fund reduction is certainly there as a percentage of CASA in our business grows. So that's something that we're focusing on, and it comes through our product launches and our branch expansion, because still consumers may not want to use the branch, but they want to know there is a branch.
Yeah.
So you really want a high street presence to make sure that consumers do feel, yes, I know this bank, it exists, and I feel more comfortable seeing it, though they may still invite our banker home, or they'll still go digitally or through the call center.
Yeah, absolutely. Talking about branches, you have 760 currently. What number would you go to, and how quickly are you looking at growing it?
So I can tell you how we are looking at, first, we have a lot of the branches which are microfinance branches, mainly in the large cities. So over the last 2-3 years, as we have transitioned from an urban microfinance more to a rural microfinance, a lot of these branches we are converting into affluent area liability branches. So Bombay example would be, we had a branch in Sion, which was doing microfinance, that's moved on. We had a branch in Andheri, which is in a microfinance area, which is now moved to an affluent area. So our next bias is to really move all our metro cities and urban center branches from microfinance spots to bank branches. So while the bank branch size may not grow significantly, what will happen is our affluent presence for liability generation, for wealth management, for securities trading, etc., that will keep going up because we'll be transitioning these branches. So I do think we have another 1.5 years of work as we kind of fully realign our branch network of 760 into the right spot. So it may not be a big jump in cost, it will be a marginal increase, but it will really realign ourselves to the way we are.
So no concerns on OPEX being elevated because of such aggressive expansion plans?
So OPEX will increase slightly, but nothing elevated. Like I said, see, for a bank which is 5 years old, you have to measure what you do. So we've always done it in a measured way, saying, listen, first what we do, we have to do it well. We have to get some amount of recognition for it. And when we are ready, we launch the next product. So for example, we don't have credit cards. We don't have car loans. Yes, we will do that, but we will choose our pace, and we will also go by customer choice. So for example, our customer base wanted two-wheelers first, rightly so. Now as we are growing, we can see now the four-wheeler demand is coming in. So now we are kind of starting imagining, hey, listen, now we're getting ready for the next phase. So starting at the bottom end and moving up in the pyramid, we are somewhere in the middle now, and I still think there's a lot of work to do.
But tell me, we're talking about the times when behemoths like HDFC and HDFC Bank, now in their combined avatar, are, getting created in front of our eyes. And they also, I'm guessing, would be very aggressive in terms of penetrating deeper into the rural markets. How do you compete with such large banks? Or is that competition at all or not? You do your own thing.
How should I say it? Okay, first, I think there are probably 500 odd very active NBFCs, and so everybody's got business. There are banks which all have business. So I think if we do want to get to the 5 trillion economy, the banks have to play a large role.
Absolutely, yeah.
And I can tell you that the penetration of credit still is probably a long way to go. Second, also remember, as the wealth effect grows, there will be a need for even more credit because people will have higher aspirations, will need to borrow more. So I do think that as of now, it's less worry about whom are you competing with. I think for us, it's more about, is my credit model suitable to the customers I'm addressing? Because I think addressing the right credit model can make a big difference of how you bring in the customer. Is my economic model right for us to be a profitable entity and yet serve the customer? So I think it's about the models you create. And I think if your model is good, you can compete with anyone. There is no reason why we would not be the bank which everybody will say, listen, look at their model and let's try be like them. And I think that's how we all think. If you just keep consumer focused, I think everything else will fall in place.
That's great, Ajay. Good to have you in the studios and all the very best. Thank you so much. Okay, let's move on. Let's discuss what the prospects of the real estate sector are. And we have with us Gaurav Pandey, the MD and CEO at Godrej Properties, joining in on the show right now. Remember, you're getting the quarterly updates as well coming in. Real estate by far year to date has been the best performing sector as well. So let's chat a little bit more about this with Gaurav. Gaurav, hi, great to have you on the show. Gaurav, specifically talking about Godrej Properties, given the spate of land acquisitions you've done recently, how's business development expected to pan out for the full year? And also, do you think your business development guidance would be a bit conservative as opposed to last year?
Essentially, we see last financial year was a very exciting year for us because we saw amazing set of opportunities at the right price point, as well as the micro markets and locations. We were very clear we wanted to take our presence stronger, and we did close to about 18 transactions with a locked in booking value of about 32,000 crores. So you're right that last financial year was really an exciting sort of point of inflection for us. And we've seen a good start for this financial year. We've already concluded 2 transactions, as you would have known, with one in Kolkata and one in Gurgaon. And we expect the momentum will continue. And we are hopeful that our guidance that we've given for business development will meet. Finally, what you achieve, especially in investment opportunities, is more guided by the opportunities you get to see, in terms of land market. So if we do see is when we actually really move to a transaction. We're not really dictated by a sort of a clear target in our mind that this is what we have to achieve. It's more about the opportunity that we get to see in market. So if we see more exciting opportunities, we would continue to explore more, but we would be more than happy to be very selective and take bets where we are very confident in terms of creating profitable growth for GPL.
I take your point completely, but Mumbai continues to be quite attractive market for you, as you also highlighted. But you have been acquiring parcels, as you point out as well, in Kolkata, Gurugram as well. Is this a specific strategy in mind to get out of Mumbai and diversify more, or that's just how demand is looking like to you?
Thanks for the question. See, essentially, if you see, we are very clear in our stated strategy of being present and deepening our presence in the 4 large geographies, which is NCR, Mumbai, Bangalore, and Pune. And if you ask me where we see the most potential excitement happening right now, and where we also need inventory, it happens to be markets like Gurgaon, which is presenting a very consistent performance in our portfolio and market overall as well. Bangalore, because Bangalore has been one of our turnaround kind of a zones last financial year. We grew from a base of around 700 plus crores to 2000 plus crores in one financial year. So Bangalore will be a place we will continue to invest. And Mumbai and Pune are anyways opportunities which we have concluded and will continue to explore. So we see presence and deepening of presence in these geographies. In tier 2 and tier 3, frankly, we're not really looking at any opportunities on the group housing side right now, other than, of course, plotted opportunities where we feel it's a low risk and high return and a short duration kind of a opportunity, and at the same time getting to learn from the market what kind of market it presents from a long-term point of view. But our focus continues to be exactly on these 4 key geographies.
Okay. Morning, Mr. Pandey. Now, we also wanted to get in your take on the launch pipeline. What are some of the launches that you've planned, and what would be the potential top line?
So, we have a very exciting launch pipeline thanks to the great business development that we did. Our teams could pull off last financial year, and we hope to see some of these launches happening up as soon as H2 of this financial year. From a pipeline point of view, if I talk about new launches as well as phase activations, which is unlaunched phases of projects that we have a very exciting pipeline of close to 28 projects slash phases. Of this, you would appreciate it's very much dependent upon the approvals. So it will be fair to estimate that some of this will happen, some of new surprises might also happen. But overall, a very exciting pipeline we've built. We've given a guidance of 14,000 crores for FY24, and we are reasonably confident of achieving that.
Right. As per a latest ANAROC report, housing sales were at an all-time high in the quarter ended June 30th. How have your sales and bookings panned out for the first quarter? And could you also highlight the factors aiding the momentum despite headwinds, such as large mortgages, layoffs, etc.?
Q1, I don't want to comment because we still haven't released our Q1 results yet. That aside, I think if you see overall, the trend we are clearly seeing in the last 18 to 24 months is that market is very, very exciting right now. We are seeing unprecedented attraction from end users. We are extremely product driven as a company than just aspirationally looking at payment plans, which some geographies, some players may be doing. So our end user driven products, we are seeing fantastic demand and some reasonable price growth as well. And we expect the same momentum to continue. From a booking value or a performance from the year point of view, I think it will be launch driven. So whichever quarters we get to see more of approvals coming in on time, you will definitely see much stronger spikes in those quarters. But on a complete year basis, the guidance that we have given, we seem very reasonably certain to go towards that trajectory.
Sure, but just before we let you go, Mr. Pandey, your take with respect to how the demand-supply dynamics are shaping up, because on one hand, the new launches continue to be quite high, but then there's this worry about increased inventory as well. What's been your reading?
See, supply and demand, if I were to break it down, right, again, there are different developers with different product strategy, market strategy, and that itself determines risk management as well as ability to charge a premium. So if you see Godrej Properties in the last 10 to 12 years, even in a degrowth market, which was pre-COVID, we were the only one of the few players which were actually clearly seeing benefits of consolidation and growth. It so happened that we moved from 5,000 crores to 7,800 crores in, for say about 5 years, from FY18 to about FY22. Last financial year was a point of inflection for us where we grew more than 56% to 12,200 plus crores kind of a number. So, and that clearly represents the strategy that we focus is end user driven markets. And that is which is continuing seeing demand and which allows you to charge up to, of course, a logical level price premium opportunities. In the current cycle, again, I think we have to take supply with a pinch of salt because, what gets attracted to consumers, what we are seeing right now is that they are more focused, especially post-RERA, they're more focused to developers which are corporate, which are sustained there for a while, which have good corporate governance. And that gives you sort of an edge. So from a demand point of view, we see that developers who have that similar repute, they tend to see very fantastic launches as well as good sustenance sales. And that allows them to charge a reasonable premium to their product. They're not really driven by sort of a figure of absolute inventory launches, which we get to see. Because some developers will launch products designed for investors. We tend to refrain from that segment.
Appreciate your time. Thank you so much for joining in and giving us a sense as to how business is shaping up at Godrej Properties. Let's put the spotlight then on the buzzing stock in trade today, Samvardhan and Motherson. Remember, through its wholly owned subsidiary, SMRP, they've entered into agreement to acquire a 81% stake in Yachio's four-wheeler business, which is a subsidiary of Honda Motor. That's That stock is currently flying high in today's trade. We've got Laksh Vaman, who is a Segal, Director Samil, as well as Kunal Malani, the CFO of Samvardhan Motherson, joining in to discuss the contours of this deal. Kunal, I'm going to begin with you. The valuation of this deal, it's close to 1.7 times the EV EBITDA. It does look fairly attractive, and the margins of Yachio are over 11%, which is higher than the consolidated margins of Samvardhan at about 8 to 9%. How EPS accretive is this deal according to you?
It is actually a net cash balance sheet that we will be buying, and hence a very exciting transaction for us. It's actually a very strong partnership that we have created here. Honda San will retain 19% in this business, and together the objective is to then grow this asset from here on. On the number side, you're right, 23 billion is the 100% of equity value. 81%, that is 19 billion, is what we will end up paying for this asset. From a transaction structure perspective, we will be post on now this announcement, we will be going for antitrust filing, after which Honda San will be making the tender offer. Once the tender offer is successful, for which it needs to acquire 66.67% or 2/3 of the shares, is when the tender offer will be successful. Post that, it will acquire 100% as per the Japanese regulations. Honda San, mind you, is already owning 50.4% of Yachio today. After the success of the tender offer, Honda San will buy the two-wheeler business out of this, and then out of the remaining is what Motherson will buy from Honda San for the 19 billion JPY, as we were mentioning. So it is an equity transaction. All the cash flows associated with between now and closure will actually be part of the transaction itself. And we expect it to be a net cash accretive transaction at that stage. I mean, net cash balance sheet that we will be acquiring at that stage as well. Given all these elements that have to come into play, we expect the closure to be in Q1 FY25. And that's the time that we have to, spend this money as well.
Okay, so a lot of details coming in there, expecting the integration to happen only in Q1 FY25, and then of course it's going to be accretive both in terms of the balance sheet as well as P&L. But gentlemen, first up, congratulations on this acquisition, but just give us a bit more detail with respect to the financials. The revenue and the margin number is available with respect to the stock exchange intimation, but what about the profit? What about the cash which is there on the books for Yachio?
If you look at the public disclosures of Yachio, given it's a listed entity, you would see that it is a 45 million odd euro net cash situation that it has today. As I said, there is a series of transactions that has to happen between now and Q1 FY25. The business will also be running in the intermediate and hence possibly be generating more cash on its way as well. We do anticipate that with the traction of the business, the performance, as you rightly said, it is a double-digit EBITDA margin business. It is generating close to 95 odd million euros of EBITDA. We do not see this as we anticipate this to be a fairly EPS accretive transaction, whichever way you frankly cut the piece.
Yeah, if I can add to what Kunal is saying, I think the really special thing about this company is, look, it's a technology leader. Its product portfolio is not just one product, it's multiple products. Of course, now the largest chunk of the pie is fuel tanks. And as well as sunroofs, and they are really specialists in sunroofs. They have full capability from low end to the high end, and have the lion's share of Honda San's sales for this product. Of course, historically they have focused on Honda San, so we know the strict technology requirements that Honda San has for its products and the quality requirements that enable us to really bring in a lot more customers.
Okay, so Vaman, you highlighted that there is a significant insourcing opportunity with wiring harness, tooling, polymer, etc. So, how much of an impact will this have on your margins?
Yeah, we anticipate significant synergies to be driven once, of course, the transaction is closed. As you can imagine, this is a public listed company. So we can only estimate at this point, but we believe that we will have a lot more color on it once the transaction closes. All the products that are being used, they are using obviously plastic parts, they're using elastomer parts, they're using machine parts. So a lot of stuff is already present in Motherson's portfolio. We have economies of scale in getting raw material. I think again, our geographical footprint, our access to facilities which are close by to the customer, and also, we believe that the fuel tank business is something that will continue and has a long tail. And as the future is also going to be perhaps with hybrid vehicles, hydrogen vehicles, this company has the unique capability to continue to develop these products for the customers. So again, we believe that very, very strong partnership is being formed with the acquisition of this company. Very, very positive outlook on where we can take this and significant insourcing opportunities, which will continue to drive a higher ROS.
Just Lakshya, follow up there, because you did talk about how this company has a capability in the hybrid vertical as well, and we usually talk only of the EV contribution that is there in the order book for Motherson. But going forward, what kind of potential do you see from the hybrid segment?
So I think you have a couple of questions there. I think the first one would be, look, we think fuel tanks have a long tail. This company not only is going for the regular fuels, but has capabilities to develop for the hybrid models. Also for hydrogen, has a complete development capability to develop that in the future. I think at Motherson, we believe that the future will have a lot of different offerings. I don't think it will only be EV. There will be space in the market for newer technologies and all these technologies that I've mentioned before. So the whole there's a lot of opportunity really out there, and we still haven't touched the commercial vehicles, off-road vehicles, what sort of energy they will be using. So again, I think Motherson's job is to take this plethora of technologies that Yachiyo has been successful in building to our other customers. And we believe that we will have success because they have very, very good technologies. Not only that, in sunroofs, they're a leader. They've been doing this for a very long period of time and have the lion's share of Honda San's requirements for this product, which can be easily taken to the other customers as well. And not only that, this company has been a real evolver. In the past, they've also been able to manufacture and assemble full vehicles for Honda San in the past. They do plastic tailgates. They have a bunch of different technologies which are, quite ready to be taken to the other customers as well. So I believe everything that we've seen really paints a positive picture for us with a lot of growth opportunities. And like I said, I think there is a good future for all its products in the portfolio.
So then, Vaman, Honda is 90% of your customer base. So what are the plans to expand the contribution of other customers, which are some of the other Japanese customers that you plan to tie up with?
Yes, well, of course, 90% of this company's customer base is Honda-san, but there's 10% of the other Japanese customers as well. And of course, Motherson, we ourselves are also catering to some of these customers in different markets. So this only cements our position. We're able to, of course, offer the existing product line of Motherson, other components also to Honda-san. I think this is something that is exciting for them. This is probably the reason why they're also continuing this partnership and retaining the stake, because they do see wonderful opportunities of business growth together with the Motherson Group and its products. The footprint of this company is amazing. It's strategically aligned to a lot of key places internationally where there are other customers located as well. So there's a lot of possibility again to cross-sell to these customers. And their strength, of course, in the existing products, such as sunroofs, such as fuel tanks, also capability to do plastic tailgates. This all augurs very well for Motherson, where we believe, I think, again, that we can continue to grow the product offering and diversify to the other customers.
Okay, gentlemen, on that note, we'll let you go. Thank you so much for joining us. And yes, the street is giving a thumbs up to that big acquisition and the plans that you have for the company going forward, 7% higher as far as Motherson is concerned. But the big talking point for the market has been the slew of block deals, large deals, IPOs that we have seen recently. Is that momentum likely to continue? What does it mean for the liquidity and the appetite in the market? Let's decode all of that with Mr. V. Jaishankar, the Managing Director and Member of Board, Kotak Investment Banking as well. Hi, good morning, sir. Thank you so much for making time and speaking with us. First up, we've of course seen the June number for block deals being at the highest level over the last 3 to 4 years. The question is, how long do you see this supply and these block deals really continuing in the market?
So I would say the block deals have been quite prevalent for the last 18 months. So even if you look at calendar 22, we had about $14 billion of blocks, right? So fairly some of the large transactions that happened the previous year where the Max Healthcare sell down by KKR and CPPIB selling down in Kotak, we are involved in both of these transactions. And the first one is about $1.5 billion in 2 tranches. So it's not that blocks have not been pretty prevalent over the last few quarters. In fact, it has been. It's just that the momentum has picked up very significantly in June. And the factors are, one, the India macros are being seen as very strong. Corporate earnings are very strong. And FPI investors are back in a very, very significant way. I think they have probably pumped in more than $10 billion in the last quarter, along with the DI flows. All these flows have really supported. And whenever you have these strong flows, you also need some very strong supply of paper. And the block deals from whether it's the promoters or the private equity investors give you that window. For example, in June, as you rightly said, about $6 billion got done. And we at Kotak were involved with about nearly $2 billion, roughly about a third of them. And we saw some very large sell downs by CPPIB and Kotak Bank, around 40 million. We had 2 very large OFS transactions of Coal India, 500 million, Manyavar, about $350 million. And all these had very good response from both foreign and domestic investors. So I would say this momentum will continue. The reason for that is IPOs take a much longer lead time. And the IPO momentum got broken. I would say in calendar 22, you had only 5 to 6 months of window open, unlike blocks which are open probably for practically 11 months. And therefore, for some of the large issuers, we are having more conversations now. That momentum is picking. But for some of the large issues to come to the market, it will take some more time. I mean, we had 2 large IPOs of Mankind and Nexus REIT, highly successful transactions, both of them over 500 million. But we will probably see a lot more of the small cap and the mid cap IPOs happening over the next few months. So I would say, therefore, IPOs will see a lot more of the small cap, mid cap for the next few months. Block momentum will continue. And that augurs well because it tells even for the IPO investors that money is available.
Absolutely. But would you say that, the investor on the street is a little bit more seasoned and has burned their fingers and therefore learned their lessons from what we had 2 years back when you had the plethora of, the new age tech companies come to the street? I mean, while there have been some great subscriptions from the IPOs of late, but then there has also been that PKH Ventures wherein the IPO had to be recalled.
Yeah, so we are not involved with PKH, so I will refrain from commenting on that. But if you look at the IPOs that happened in the second half of the last calendar year, especially in the hospital space and in financials and consumer, most of these companies have gone on to give very good returns. So I would say investors have probably benefited from some of the IPOs in the last, call it 9 months or so. Even Mankind Pharma, it's probably up more than 50%. Nexus REIT is again trading in a positive zone. So I would therefore say investors have had a fairly pleasant experience, particularly in the last 9 months. The correction of the excesses of 21 is by and large done from a valuation standpoint. The other thing that I would say is Indian market will always see robust valuations, whether it's listed or companies that come to the market. And I would say in the last 9 months, investors, particularly institutional investors, have been a lot more focused on profitable growth companies. And that's why you probably see a better discipline and a better return profile to the IPOs of the last 9 months.
Sure, Mr. Jaishankar, just wanted to talk to you a bit more about, what you said. Of course, perhaps class of 23 will not be the case, the like of class of 21 that we have seen on account of the valuations. But in terms of the pipeline going forward, is there a, mad rush with respect to the promoters and large investors to offload via block deals? Is the pipeline very, very strong for July, August as well? IPO, as you pointed out, might take 5 to 6 months as well. But will the next couple of months be as good as June when it comes to the block deals?
See, the IPO pipeline will be very nuanced in my view, because the 22 year was very challenging. And you probably had only 40 IPOs getting done. Roughly about $7.5 billion were raised on the market. The largest one, of course, LIC. So if you take LIC x LIC, that's $7.5 billion, comes down by a good nearly 3 billion, right? So that momentum was broken. We had at the peak about 120 documents filed with SEBI, and therefore the excess of 21 that you probably saw in the filings, and many of those IPOs probably will not get done. Some of the documents the time period is also expired. But currently, if you see the number of documents filed with SEBI, it's probably a more saner number of, call it 70 number, right? So 120 has come down to 70. And I do notice a lot of small and mid-cap IPOs probably better positioned, as I said, for the next few months. And the reason for that is some of the large cap IPOs, that momentum got broken because of what happened in 22. And these companies, they're not in a hurry. They could get external financing. So we are seeing a lot more conversations with the large cap IPOs in recent months. And therefore, I would say this would probably, you'll probably see larger IPOs coming towards the end of the calendar year, more of the small cap, mid cap, but the momentum is certainly picking up, and it'll be probably a far better 23 compared to 22.
You know, on the point that you're making about there will be more IPOs from within the small and the mid-cap arena, would you say that a lot of SMEs will also be hitting the primary market?
You're right. I think that you will see a lot of IPOs of a size anywhere between 500 crores to 2,000 crores really hitting the market. The market cap of these companies could probably be anywhere from, call it 2,500, 3,000 crore to probably 6,000, 7,000 crores. So you are going to see a lot of the small cap companies coming to the market, and many of them are very profitable. Many of them are doing well. And since some of these documents have been filed with SEBI for a fairly long period of time, investors have also been able to track how these companies have progressed since the filing. And this is giving greater confidence for many of these small cap IPOs to happen. Of course, the market being at an all-time high, there are great flows into the small cap mutual funds. So investors are also looking for good ideas, and all of it is coming together at the right time.
And Mr. Jayashankar, just before we let you go, I know it's difficult and it's very broad-based, but is there any sector which is seeing a lot more interest from the investors as well? We've suddenly seen a slew of all of these manufacturing companies coming on the anvil. Is that something you're witnessing as well?
You're right. I think over the last few quarters, we saw more IPOs from financials, consumer, and healthcare. But we are now beginning to see this getting a little bit more broad-based. We are seeing companies in the infrastructure space, companies in the capital goods space, in the broader services space coming to the market. So you will see a more broad-based sector themes playing out over the next few quarters as compared to what you saw in 22.
Shankar, we let you go. Really appreciate you joining us on the show today and talking to us what's happening with respect to the primary market as well as what's happening in the special windows transactions as well. Shifting focus to the market, and with respect to some of the stocks which are buzzing around, take a look at Dish TV. If I have it right on my screen, that stock has suddenly zoomed. I'm not sure if there's any incremental news flow on that one, but a sharp spike of almost 9% coming in there. You of course have Motherson Sumi, which is going strength from strength, so 8% higher. Karur Vysya Bank is also seeing quite a bit of traction. I don't think there's any update around that, but the entire banking sector is getting a bit of a fillip given the Q1 updates have been quite all right. Karnataka Bank is the other candidate. You have JSW Energy, which is riding the wave. And pull up Genus Power. We spoke with the management, that big tie-up happening with GIC, and the fact that they are putting a lot of money into Genus Power is something which is taking that stock high by 20%. In fact, if we can, let's try and pull up 1 month chart of it or even a 5-day chart, and that will tell you there's a massive momentum build up when it comes to this entire smart metering sector. Not just Genus Power, you also have HPL Electric, which has been on the anvil on account of that. So just watching out for a couple of these counters. All of them doing well. Seat is the other one, which is high by 4%. Colgate Palmolive, I think there was a note that came in from Nuvama there, so that stock is also high by around 4%. A lot of big movers. On the losing side, it's HDFC Twins, down anywhere between 2 to 3%. Bandhan Bank down about 5%, and then Suzlon Energy taking a bit of a reprieve after that massive run-up that we had seen as far as Suzlon is concerned. But on that note, stepping into a very short break, don't go anywhere. When we come back, we discuss the chartbuster ideas with our technical experts.